Welcome to the Stock Market Palantir. Today we are going to talk about PHUN, Phunware Incorporated.
And this is one of the most intellectually compelling microcap situations out there right now. It's a genuine special situation, really defined by a structural complexity and frankly just a bizarre capital dislocation that you rarely see.
Absolutely. The structural issue we really have to address today revolves around Phunware's valuation anomaly. We're looking at a company where the market valuation seems completely detached from the balance sheet. As of late November 2025, the market cap is hovering around, $42.8 million.
Right. But the balance sheet tells an absolutely extraordinary story. If you look at those Q3 2025 financials, the company reported a massive $103.8 million in cash and cash equivalents.
That's the number. And when you subtract liabilities, this translates into an enterprise value, the value of the operating business itself, of approximately negative $61 million. This is the core of our discussion today, negative enterprise value.
So the central question then is whether this mathematical oddity is just an irrational mispricing, an arbitrage opportunity protected by an undeniable cash floor, or if the market is in fact being perfectly rational and signaling its belief that management will inevitably, incinerate that nine-figure cash pile through operational failure and poor capital allocation.
I see why you think that, but I have to contend that the sheer weight of that cash position creates an asymmetric risk profile that is just too powerful to dismiss. The downside is, at least theoretically, limited by this liquidation floor, while the upside is potentially explosive.
And I'll be arguing that this discount is fully justified. It's justified by the operational reality, the structural decline of their legacy business, and maybe most importantly, the deafening lack of confidence from the company's own insiders.
Okay, so let's start by defining that arbitrage opportunity, because the numbers themselves are just staggering. When we say negative enterprise value, we mean that an investor is currently able to acquire the operating business, Phunware's tech, its IP, its employees, for less than nothing.
And let's just unpack that for a moment, because it sounds abstract, but it's not. If you were hypothetically some private equity buyer, you could pay $42.8 million to purchase all the outstanding shares. Instantly, you would get $103.8 million in cash back onto your balance sheet. That transaction results in you receiving the entire operational entity for a net profit of $61 million. It's, mathematically speaking, the ultimate free business scenario.
And this isn't just about liquidation value. It's about the cushion it provides for the ongoing business. This massive cash holding translates to a price-to-book ratio of approximately 0.41. The stock is trading at less than half of its net asset value. That is highly, highly uncommon outside of, deeply distressed, near-bankrupt situations, which Phunware is clearly not.
Okay, but while the numbers are compelling, I would challenge the whole premise that this is an arbitrage opportunity. Arbitrage implies some kind of certainty, usually driven by a hard timeline or a management team that's committed to shareholder return. Where did this massive cash pile even come from? It's mostly from prior shareholder dilution, right? From the SPAC boom and all those subsequent at-the-market offerings. Management has a clear history of raising capital at much, much higher valuations.
But that historical dilution is what funded this runway. Based on the Q3 2025 burn rate, we're looking at an annualized cash burn of roughly $12.4 million. That gives them a cash runway exceeding 8 years. I would argue an 8-year temporal buffer fundamentally changes the risk-reward calculus. This is the very core of the asymmetry. The near-term downside is structurally capped by that cash floor, while any operational success, no matter how small, has massive re-rating potential.
I'm sorry, I just don't buy that the market is wrong to price in the expectation of capital destruction. That 8-year runway is exactly what the market fears management will use to delay painful decisions and fund high-risk, zero-return projects. That cash isn't viewed as a safety net. It's viewed as a liability in the hands of this specific management team.
That fear has to be grounded in the present operating results, doesn't it? Are the losses so significant that they actually overwhelm an 8-year buffer?
They are significant enough when you view them alongside the total lack of revenue generation. Look at the operational reality in the Q3 2025 report. Net revenue was only $600,000. It contracted 6.5% year over year. The legacy mobile advertising and location-based services business is shrinking. It's melting away. They continue to report a negative net loss of $2.4 million and a negative adjusted EBITDA of over $3.3 million. The business is structurally unable to sustain itself.
I would point out, though, that management is actively reducing costs, and the losses are improving year over year, to their credit.
That improvement in cost control doesn't justify owning a negative EV stock when your top line is actively shrinking. The market fears mismanagement, specifically poor capital allocation. They are actively pivoting to high-risk R&D, namely this AI concierge, while operating at a substantial loss. The market believes management will use that $103 million for an ill-advised acquisition or continued speculative R&D that yields zero commercial return rather than listening to shareholders and returning capital via buybacks. The negative EV is the market's calculated price for this existential execution and governance risk.
Okay, let's pivot to that strategic turnaround then. Because I think the market is completely misjudging the necessity and the optionality inherent in the AI concierge pivot. You characterize it as poor allocation, but I see a necessary and potentially highly effective use of their existing LBS technology in a high-growth vertical like hospitality.
I just come at it from a different angle. I call the AI concierge initiative vaporware risk right now. That 6.5% decline in legacy revenue suggests the core business is disintegrating faster than the new AI vertical can solidify. They are in a revenue air pocket. The product, which aims to combine LBS with generative AI for hotels, is still only in pilot testing.
And why does that concern you specifically?
Because the journey from pilot testing to commercial contract conversion is just fraught with risk, especially in enterprise software sales. We call it pilot purgatory. The pilot might look great, but if the integration costs are too high or the ROI isn't immediate, those deals just die. Why should the market assign significant value to a white paper and an idea in testing when the actual revenue-generating engine is actively shrinking?
I'm not convinced by that line of reasoning, because the upside of the pilot converts is clearly defined, and it's disproportionate to the current market cap. The pivot is to a vertical-specific AI vendor, and we have specific, quantified evidence of the potential, not just speculation. That white paper they released on November 3rd details a pretty compelling revenue optimization strategy.
A white paper is a sales tool. It's not revenue.
It is evidence-based theory that projects a conservative $2 million plus annual revenue opportunity for a typical 200-room hotel property. That's generated through ancillary bookings and service upselling that's enabled by the AI. That single data point suggests a non-linear upside. If Funware secures just one or two definitive contracts based on these economics, the valuation, which currently sits at $42.8 million, would have to fundamentally change overnight. The market is ignoring this optionality entirely. It's pricing it at zero.
But that requires management execution and belief. And this brings us directly back to governance and insider signaling. How can you argue this is purely an irrational market phenomenon, just psychological distress from retail investors who have suffered through that painful 1-for-50 reverse stock split and the complete evaporation of the Trump trade premium, when the very people who know that $2 million revenue potential best are doing nothing?
I acknowledge the pain in the overhead supply created by the reverse split. It undoubtedly causes psychological damage and it dampens rallies. But the mathematical anomaly, it still persists.
And that anomaly is explained by the deafening silence of insiders. This is the most bearish fundamental signal we have. Despite the stock trading at these, crisis-level valuations, less than half its cash value, there has been absolutely zero open market buying by insiders in the last 3 to 6 months.
I see your point. The regulatory filings, they only show selling or dispositions related to stock options or tax requirements.
Exactly. If the interim CEO Jeremy Kroll or the board truly believed in that $2 million per hotel revenue potential detailed in their own internal documents, they would be buying stock personally. They would be leveraging this immense mathematical discount. Their inaction sends a powerful signal to the market that they either lack confidence in the immediate commercial viability of the pivot or they plan to use the cash pile for other strategic endeavors like acquisitions or executive compensation that don't directly benefit current common shareholders. Until management puts their own capital on the line, the market's skepticism is entirely rational.
That's a compelling argument regarding confidence, I'll grant you that. But let's transition to the mechanics of the market itself, specifically the microstructure, which I believe actively reinforces this depressed price environment and, ironically, creates a massive latent risk for short sellers.
You're talking about the abnormal trading mechanics, the heavy use of dark pools and internalization, which I agree is highly abnormal for a microcap like this.
Right. We see that a staggering percentage of daily volume, often exceeding 40% and sometimes peaking near 50%, occurs in off-exchange dark pools. On November 20th, for instance, the off-exchange short volume ratio spiked to 53.70% of that day's total volume.
And this heavy internalization by large wholesalers and market makers, it fundamentally dampens genuine price discovery. When retail buy orders are routed away from the lit exchange, from the NYSE, they're prevented from pushing the price up, while short sales are executed off-exchange, reinforcing this whole narrative of price suppression. The price action you see on the chart just isn't a true reflection of matched public supply and demand.
While I acknowledge the detrimental effect of the dark pool data on price discovery, I would argue that this very microstructure works both ways. It creates a significant liquidity trap for the short sellers who are currently pressing the stock lower.
But the overall short percentage of the float is only about 5.4%. That's not classically high short interest that screams squeeze potential.
Short interest percentage can be really misleading in ultra-low float, low-volume stocks. Days to cover is the crucial metric here, because Phunware's average daily volume has dried up so significantly, partly due to the reverse split, partly due to low interest. The days to cover metric stands at approximately 5.06 days.
So that means it would take short sellers nearly a full week of trading every single share just to close their positions.
Exactly. 5 days is an eternity in a volatile microcap. If a genuine catalyst were to occur, if that AI pilot converted into a material contract, or if management finally announced a shareholder return policy, the combination of the low trading float and the severe lack of liquidity could force the price up violently. Shorts would be competing for a negligible supply of shares, creating a massive snapback. The dark pool activity, by artificially dampening volatility, is essentially just building tension in the spring.
It's a high-risk trap, I agree, but it relies entirely on a catalyst that remains theoretical and unproven. The stock right now is being defined by tax loss harvesting and technical trading that's driven by market structure, not by fundamental optimism about the AI pivot. And that means the market is rationalizing the discount even if the price itself appears irrational.
Which provides the unique opportunity for those willing to accept the fundamental risk and bet on the mathematical reality. To summarize my perspective, PHUN is defined by a deep mathematical discount that presents an extreme asymmetric risk play. Investors are effectively acquiring the operating business for negative $60 million. Downside risk is heavily cushioned by the $103 million in cash and that 8-year burn runway. The upside, driven by the exponential potential of the AI concierge pivot and the structural volatility inherent in its low float, it's explosive. It's a stock for the sophisticated arbitrager willing to bet that mathematical inefficiency eventually wins out over execution fears.
And I maintain that the market is being appropriately cautious. The $103.8 million cash pile is not a safety floor. It is fuel for future operational losses and questionable capital allocation, especially given the persistently negative EBITDA and the shrinking legacy revenue stream. Until operational metrics prove that the AI initiative is successfully replacing the dying legacy business, and critically, until management shows confidence by putting their own capital on the line through open market insider buying, the negative enterprise value is a rational signal of deep governance risk and future value incineration. The stock is defined by volatility, legacy churn, and the high hurdle of an unproven AI pivot.
The tension between the balance sheet and the income statement, between mathematical value and execution risk, that really is the essential conflict here.
Indeed,
as is the tension between the theoretical upside detailed in their white paper and the actual actions of insiders and market makers in the dark pools.
So we have covered the complex structure of Phunware Incorporated, the nature of its negative enterprise value, the viability of the unproven AI concierge pivot, and the impact of dark pool trading and short interest on its current valuation structure.
It's a special situation that really requires deep scrutiny of financial statements and market microstructure at the same time, rather than just simply looking at a price chart.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.